A very good evening to you all, and welcome to our retail webinar on the equity market outlook. My name is Dilushka, and I have my colleague Sajid with me to run through our outlook on the equity market for the next few months. So the structure of today's event would be: we'd start off with a bit of a macro outlook for a few minutes, then we'll move on to the equity outlook overall, followed by a Q&A session. If you have any questions, please feel free to put it in the quick Q&A box in the chat option, and we will answer your questions later on at the end of the webinar. Moving straight into it with the macroeconomic outlook overall. Starting off with the interest rate outlook, broadly, our expectations for interest rates remains constant since our last webinar. We expect that we'll end the year with the bills being around 8 to 7.5%, and 2026 ending with between 7.5 to 7%, which is a reduction of about 50 basis points. Looking at key themes that will be there, firstly, the reason for interest rates going down overall next year is the inflation risk being subdued. While the cyclone Ditpa does give a bit of pressure onto inflation, there is still potential for the inflation rate to remain at about 3.5 to 4% for the year, which is below the 5% inflation targeting that the central bank is maintaining. So there is still a comfortable leeway despite food inflation, which could potentially go up because of the shortages, because of the damage done to the crops on the back of cyclone Ditpa. Also, on top of that, looking at the positive primary surplus, which Sri Lanka has been able to maintain for 2025 and is expected to maintain going forward as well, which gives Sri Lanka more leeway with regards to the easing coming from the domestic front. Also, the cash buffer which CBSL has been maintaining would also come in useful and enable to maintain maintain its interest rates. On the GDP front, our expectation is that Sri Lanka would be able to maintain a GDP growth of around 4.5% for the year, followed by around 4% for the period 2026 to 2028. While once again the cyclone will have a marginal impact, we expect there will be a marginal impact which might come up on the GDP growth because of the infrastructure and also the agricultural hit which has come because of the cyclone Ditpa. So there is a marginal impact, one-off sort of drop that might happen, one-off reduction in the growth rate that might happen in the short term. But in the longer term, as recovery kicks in, we do anticipate that steady growth would start coming in once again. Key themes is one, the improving household expenditure. Yes, for now there has been a bit of a hit on household income because of the cyclone, but we have seen that the government has also taken proactive action to sort of make sure that recovery is a much more smoother effort. On top of that, even the credit pickup which I've been seeing so far. Once again, because of the cyclone, we do anticipate a bit of a dip, a bit of a slowness credit pickup over the months, but with eventual recovery, and also CBSL taking necessary actions to promote SME related loans going through with tip moratoriums and also rates for flood affected individuals. We do anticipate that there still is potential for growth, despite it being much slower than what we would have thought a few months back. Another factor which would help growth in the GDP would be the acceleration in construction activity. While construction sector would see a bit of a jump, would see over the next few months with refurbishments and also capex related to recovering from the cyclone. There is also the pipeline of projects that the government had announced in its budget, which we anticipate that construction acceleration would also still kick in as well, helping the GDP to grow overall. On the exchange rate front, our expectation is that the rupee would end at about 305 for 2025 and end 2026 at 310. Three keys on this front would be stronger tourism remittances, tourism earnings and remittances, which we have seen throughout 2025 and also still continues. Even the numbers, if you look at the tourist arrivals, it's year to date, December's numbers are marginally above what we had in 2024. So there are still signs that the tourism industry is still being able to maintain that earning capability, and also the dollar flow still continues. Another fact is the current account surplus that we've been able to maintain for 2025, and also the expectations that Sri Lanka will be able to maintain a surplus for 2026 as well, and also the multilateral and bilateral inflows that Sri Lanka will be unlocking, particularly over 2026, which would support the currency to be at that 305 and 310 levels. Moving on to the stock picks, looking at the banking sector and the overall impact, particularly with this with cyclone Ditwa. On the left side, what you're seeing is basically the map of Sri Lanka along with the rainfall during that period of 25th to the 31st of. So as you can see, a lot of those, particularly the northwestern province and the central province, have been particularly hit hard by the by the cyclone. And also with that, we do see that there's quite a bit of credit going into those provinces as well. From banking perspective, while loan growth might be a bit more slower than initially what we have expected, we do expect that there still will be credit the next few months. It might not be at as strong as what we saw over the last few, particularly towards mid 2025, but there will still be growth going forward. And the central bank has to sort of enable that credit growth to be much more stable. If you look at if you concessions that the central bank has announced, which includes debt moratoriums on the interest and no interest being charged on interest on existing loans for existing facilities for companies and individuals that are affected by floods. And also with regards to new loan disbursement as well, the central bank has been much more, has said that it will be a maximum, that will be an interest rate cap 9%. And banks can give out loans at these, give out loans to individuals and SMEs that deem affected by the floods, which is different from the last few times how banks are giving out credit during periods of debt moratorium. And from our industry, from the industry players, this seems to be much more effective way of growing credit as well, because you'd have credit going to the right places where actually they could sort of help GDP growth as well. So there is still potential for loan growth as well. Maybe not as strong as what we expected a few months back, but there is still loan growth, we feel. The main sort of concern right now with this is how do your NPLs play about with during this crisis situation. While right now there are mixed emotions amongst the industry of how this would go through. The debt moratorium which just came in sort of gives them a bit of leeway on the stage 3 level, where you won't be having three. However, you will be having affected industries and affected companies being shifted from stage 1 to stage 2, which could cause an increase in your provisioning, in the provisioning, marginally more risky. However, you would not be seeing those major provisions coming in from stage 2 to stage 3 conversion until you're done with your debt moratorium, which is a 3 according to CBSL directive which was given out, and it will be on a case-by-case basis as well. So on the right-hand side is basically the credit disbursement that is there right now. So as you can see, a lot of the credit given out in Sri Lanka goes to that construction and infrastructure projects. And we feel that this segment is likely to see a lot of credit demand coming up, given the fact that there will be a lot of working capital requirements over the next few months with refurbishments of affected areas. And also the government projects which were announced for 2026 happening as well. There is likely for that working capital requirement related credit seeing an increase. And that because construction infrastructure is such a large amount of now, there is scope for credit a little bit to see increase as well. Now the concern where you'd have the industries where the banks would be having concerns would come in the agricultural segment, which is typically where you've seen about 20% of agricultural land being damaged because of the cyclone, and that affects the ability of farmers to repay, and hence that sector becomes a much more risky category because of the cash flow issues which should come up because of the damage that has come up on the back of the cyclone. Also, places like consumption might see a marginal dip with credit disbursement, but after a certain period, you start seeing consumption picking up once again, and along with that, you see retail start picking up with working capital requirement related lending increasing. So overall, there still is scope for credit even on an individual segment. These segment majority of these industries. So the banks still do have scope to give out credit. Now, the problem that the banks will be having over the next over 2026 would be coming primarily from their net interest margins reducing. While the lower interest rate regime has sought the lower interest rate started has already resulted in there still is some more space for this to go down. Looking at the main sort of problem that they'll have is the increase in deposit rates. Given the fact that the banking industry is seeing such high demand for credit to inject liquidity, they are in their deposit rates, and along with that, the NIMs are starting to be squeezed. So as you can see, since the last 12 months, there has been increase in deposit rates among certain banks, and trend is likely to be something seen across the board in all banking sector players. While that is happening from one front, with the repricing of the loans as well, there is a reduction coming in the lending rates as well. The overall average lending rates of the banks also. And on top of this, the concession rate of around 9%, which is which is over 100 reduction from the average weighted new lending rate, would result in a marginal drop in the overall lending rate, the overall weighted lending rate of banks as well. Once again, squeezing the NIMs of the banks. However, over the last few quarters, what we've been seeing across the banking system is that yes, you're seeing your NIMs come down. However, because your loan growth is high, your net interest income is able to increase, which has a stronger, which flows down directly to the bottom line of the banks. And this is something that a lot of the banks are doing right now, focusing on being aggressive on their loan growth in order to grow their earnings. Now, the next question with the impact of be coming in on how does this affect your impairment cycles? So overall, if you look at the industry, Sri Lanka, the banking industry maintains stage cover of around 60%, with certain banks maintaining much higher amounts. While right now there won't be any major impairment cycles because you aren't seeing a lot of the loans being transferred to stage 3 until your debt moratorium period is over. For now, it's just stage 1 to stage 2 being transferred. Hence, there is no major impairment cycles which will be coming in. Having said that, there still is an increase in impairments that could come up fourth quarter. But this can more or less be negated by the fact that a lot of these banks have provided prudently on their stage 3. Because of that, there is not a major impact coming on the impairment cycle, particularly for the fourth quarter of 2025. When your debt moratorium sort of start coming off, that is when the banks would be starting to see about their impairment front. However, given the fact, like I mentioned earlier, a lot of these banks are very prudently provisioned for their stage 3 loans. There is still leeway for for the banking system as well to sort of control the level, that will be coming through. Looking at the last few years, the impairments have been a major reason. The banking system as a whole has been seeing a jump in their earnings. Going forward, particularly, they are likely to not see that because we won't be seeing things like reversals coming in from the ISBs, which sort of grew the earnings for 2024, and there would be a level of normalcy coming into the banking sector bottom line. So we won't see extreme movements in the earnings. It will be would more or less be able to maintain a much more flat growth rate with regards to earnings going forward. On the back of impairments be much more smooth as well. So where the risky loans would come up is particularly from the retail and the SME front, because these are the sectors that would be more vulnerable to fall in the category. It's likely that banks that have higher levels higher levels of loan portfolio in an SME provision, and if they haven't maintained adequate provision cover, there might be a chance of these such banks seeing an increase in impairments over 2026. However, once again, it is right now, it seems that the majority of the banking system is very prudently covered. So there is still in from this front. It seems like the banking sector is prepared to sort of make such a risk going forward as well. So to talk about the construction sector, I'll pass the mic on to Sajid. Sajid.
Thank you. So hi everyone. So the construction sector is something that we've been bullish year prior to the cyclone, and I think the cyclone has sort of propelled this sector much more positive, much more positive trajectory in terms of construction. So the key component being cement. So something we've seen is there will be there'll be much more efforts in terms of reconstruction. So something that we saw over the last year, maybe when the government did allocate for capex, there weren't much of spending. For example, the government allocated about 1.3 trillion last year for capex, but much of it didn't really materialize, partly because of foreign projects not being approved and whatnot. But this time, with the funds being reallocated or repurposed towards rebuilding, we expect much of it to flow through. And also in terms of cement being the key component, with multiple roads and connectivity platforms such as bridges, and also housing also to spike, especially because the government is paying out 5 million per damaged house and also up to 2.5 million for partially damaged house for repairs. So with the roads and also housing construction boding well for the cement industry, we expect about 109,000 metric tons to come in over the next 1 to 1.5 years. And historically, if you look at the cement consumption and also clinker imports, which is the key raw material for the manufacturing of cement. So historically, when floods did hit in September 2016 and also back in 2017, we did see that spike in terms of cement consumption and also clinker imports sort of to carry out the reconstruction phase. And also looking back, that the cyclone really hit. If you look at the construction industry, they've been at a wait and see, watch and wait phase for the past 2 to 3 years, which means they have not really carried out construction activities primarily due to costs being high. So now costs have stabilized, which also gives people the ability to construct, especially in terms of labor costs as well. So this is so the cyclone sort of the reconstruction efforts is sort of into the industry. And also looking at in terms of so like I mentioned, the cyclone being another push towards the industry is also quite beneficial for Tokyo. And if you look at the 5 million and 2.5 million payout for fully and partially damaged houses, respectively, we expect that to sort of translate into a estimated revenue for Tokyo at around 33 billion rupees to be realized over the next 1 to 1.5 years. So what we're seeing is Tokyo being able to capture a bulk of the market share from this spend, primarily given the fact that most of the damage was done on the central to the north to the eastern side of the country, not the road, not the north, the eastern side, sorry. So this means that Tokyo is able to capture more than their usual 32% market share. We assume they'll be able to capture around 50% of this spend on cement. And also we expect, especially on the front of partially damaged housing, the cement intensity to be much more higher rather than other materials. And also looking at how competitive players operate. So there are certain players which transport their produce through rail. So which gives Tokyo that benefit in terms of being able to reach certain parts of the country where your competitors aren't able to reach efficiently and effectively. And also looking at Tokyo in terms of a forward basis on looking at FY27 to FY26. So in terms of volume and market share gain, so Tokyo has been outgrowing the market. This is before the cyclone hit. The market grew at around 18%, whereas Tokyo grew at about 22% for the first half of this financial year. So we expect Tokyo to outdo this growth momentum in terms of, especially in the light of reconstruction efforts primarily kicking in. So this volume growth is also to be facilitated partially by Tokyo being available within the Western province. So one main factor restricting Tokyo's volumes in Western province, which is where 50% of the cement market is concentrated, was the transport barrier really. So right now, what they've done is they've purchased a vessel for coastal transportation, which gives them that edge in terms of being efficiently and effectively available within the Western province. So that would sort of propel their volumes, and we expect a margin uplift on that front. And also, if you look at Tokyo, it's in terms of their product strength and product quality, they are one of the preferred partners for JICA projects, which is funding the BIA project. And also for high-rise constructions, also Tokyo is a preferred partner given their product strength. So which is also it sort of bodes in well with the company coming in terms of availability within the Western province and also the demand for the product in a quite timely manner. So based on all of these factors put it together, we are looking at a target price of around 153 rupees for Tokyo in, offering a total return of around 43.8%, including a 2.5 times dividend yield. Next up, looking at the cables industry. So something that we've seen is, this was prior to the cyclone, we've seen the CEB tendering being much more efficient, and the value of the CEB tenders really propelling up compared to the last 2 years. And if you look at the first 7 to 8 months of 2025, we've seen Sierra and ACL grab up the majority of the market share in terms of the tender front. And we expect this to sort of continue, especially with reconnectivity, also restoring connectivity in areas which were highly impacted. And also, in addition to that, we are also looking at the government allocation for transmission line upgrades to be repurposed to highly affected areas. And also, a transmission upgrade would also mean there would be more renewable energy projects, which would be good for these cable companies. And also looking at the key raw material imports that we sort of track in terms of copper and aluminum imports, they are also up, with aluminum being up 46% year on year and copper being 4% up year on year. So in terms of the cable sector, our top pick for the sector would be ACL, primarily because of their diverse portfolio of having exports and also having a very strong retail and commercial presence, and also being able to cater to CB and other commercial infrastructure projects. So one main thing prior to the cyclone that we were looking at was the transmission line restoration, which was expected to bring in decent volumes from the CEB side of things. However, with some disruption on that front, probably due to reconnectivity, we still expect these funds to be repurposed to restore connectivity, which would once again boost volumes. And also in terms of margins, given that commercial projects are priced on a cost plus margin basis, which means ACL can avoid any margin volatility due to FX pressure or other raw material cost pressure from the commercial side of things, rather than on the retail side of things where they operate at a MRP, which adjusting it cannot be done quite efficiently. And also, once the transmission line upgrades do kick in, we're looking at a strong growth in terms of the renewable and the grid expansion. Grid upgrades are expected to come in, and more solar installations, rooftop solar installations are expected, which would in that case accelerate retail growth and also sort of help once again run the volume momentum of ACL. So all of this put together, we're looking at a target price of 293 with a total return of around 16.9% for the company. So I'll let Dilushka take over in terms of valuation plays.
So in terms of valuation plays, a key sort of valuation play which we have is coming in the form of Haley's. Haley's, as you know, has around 180 business units and subsidiaries. And right now, it has a market capital of around 144 billion on the Colombo Stock Exchange. However, it does have its listed companies as well within itself, like Singer, Haley's Dip Products, Haley's Fabrics, Alumex. So all of these have its own market capitals as well. And if you take the ownership of Haley's in these companies, Haley's in these subsidiaries, and if you sum that up, that comes up to 140 as of the end of today's trading day. Meaning, whatever the unlisted is of Haley's, is effectively factored by the market at a value of 4.5 billion. Now, this unlisted sector includes companies like Advantis, Fentons as well. And the implied PER of this segment would come up to 0.3 times. Now, typically, if you look at a company like Advantis, which is a logistic company, you would see it trade on an international scale at about 20 to 15 times PER. While the market hasn't really that price right now. While I'm not saying that it should be trading at a 15 to 20 times PER should be at 15 to 20 times. I'm that, but it's definitely not supposed to be trading at a 0.3 times PER. So we feel that there is a certain level of upward movement that this counter would need to have to sort of itself to be in line with to sort of in the valuation of its transport logistics segment, which contributes a large portion of Haley's of the conglomerate's earning as well. So we feel like there's a valuation play for Haley's from that front. For the next part, I shall pass the mic to.
So then we're looking at LIOC, which is sort of a contradictory view, but what we see is in terms of a strategic play, LIOC, if you look at the cash and short-term investments value of the share, it's about 113 per share, whereas share currently trades at around 129 rupees. So it's basically you're buying the cash and the business is for free. And also, if you look at the business stability, we are looking at a period of stable profits going forward, primarily because of the fuel price formula coming into play, and also prices being adjusted monthly to reflect global prices, thereby reducing margin volatility. And also something we've noticed is LIOC has been consistently reducing their inventory days. So if you look at 3-4 quarters ago, their inventory days were about 60 plus, but right now it's down to about 38 to 35 days, which means they can repurpose and adjust their inventory in order to reflect current prices, which is once again beneficial in terms of maintaining their margins. And also looking at the fact that we are on to a good tourism season, and also movement is picking up. If you look at numbers from Pick Me to monthly fuel sales, everything, which is sort of helping the momentum in terms of consumption. And also, if you look at competition, it's not really biting into the market share of LIOC. It's just that's sort of capturing or putting up new outlets, but not really impacting the market share of LIOC. And we think LIOC would hold market share of about 20%. And also on top of that, LIOC holds about LIOC makes about 1 to 1.3 billion in finance income per quarter, which is a cushion for them to lean on in terms of when the operations do really go south, or if go wrong, which is another point where they can sort of maintain stability in terms of earnings. Next up, looking at HEMAS. So in terms of HEMAS, what we're seeing is there's sort of in an investment cycle where they're investing money onto the next growth cycle. So in terms of the starting off with the consumer segment, we expect a short-term boost in terms of revenue and also bottom line, primarily because of stocking up, and also people rushing up to make donations as a result of Cyclone Ditwa for flood affected communities. However, this might slightly taper off looking a couple of quarters ahead as spending is constrained and sort of repurposed. However, that's not expected to bring in too much of an impact. Then again, looking at the pharma side of things, we expect pharma to sort of do well, especially with HEMAS having a very strong hospital and lab network across the country, especially with flood-borne diseases also sort of spreading around. They'll have that opportunity to grab revenue on that front. And also looking at the pharma side of things, usually medicine consumption does spike in such periods. However, on the downside, that's primarily impacting the bottom line would be the NMRA pricing regulations, which might margin pressure, which means currently we've seen around 350 drugs being regulated, which is the highest Sri Lanka has ever had an MRP for. And also this is expected to be applied to more drugs going forward as well, which means there will be margin pressure in the short term. However, when we speak to companies, what they're saying is they're looking at renegotiating terms with principals and passing down some of this pricing pressure onto retailers as well, which means looking ahead about 3-4 quarters, we are looking at this margin pressure easing and healthcare earnings also sort of normalizing despite these constraints. Looking at Sun, which is also another key player in the pharma front with about 10% market share in the pharma distribution business. They are also looking at a similar margin pressure, just like Hemas, primarily due to NMRA once again. So for Sun, we've been able to quantify the margin hit. We are looking at around 100 million rupee hit for the second half of this financial year. However, something to notice back in 2015 when price controls did come into play, volumes did spike. However, the spike might not be sufficient to set off the margin pressure that sort of comes in with price controls being in place. And moving on to the consumer segment of, they've sort of repurposed the sales team and re-incentivized retailers in order to really push their products, and also they've been doing various branding initiatives, which has sort of yielded results. And we've seen for the first half of the year, they've done really well in terms of an year-on-year growth, and we expect this to continue on to the second half as well, primarily because we've seen stocking up also due to Cyclone Ditwa as well. And then again, on the palm oil plantations front, what we've seen is there's a tendency for global palm oil prices to spike, given that Malaysia and Indonesia have seen that spike have been impacted by the cyclone. Whereas the plantations in Sri Lanka, owned by Waterwell, are primarily situated in the south belt of the country, which was quite safe from the impact of the cyclone. So which means they will have, and the local palm oil prices are linked to the global prices. So which means without an impact on production cost or output compromising, whatever will be able to see a spike in palm oil prices, which would help them elevate their margins. And also another factor to note is their trees at sort of their peak production levels, which is quite beneficial in terms of yield as well. Moving on to the real estate sector outlook. So a key factor that we looked at is occupancy rates of commercial properties across across listed counters. It's hovering at the 75 to 100% mark, which shows which is an indication of a potential shortage in the real estate spaces for grade A and grade B office spaces, which has really given the opportunity for existing listed counters to really spike their prices up as well and also make strong margins. In terms of a top pick on the construction, on the real estate sector, something we'll be looking at would be OSIA. So historically, when occupancy rates of their properties have sort of hovered at the 90% mark, we've seen them make operating margins of north of 70%. So currently, given that the Havelock City Mall and the Mireka Tower are also sort of just crossing that 75% occupancy rate and going towards the 90% mark, we expect Overseas Realty also to sort of keep maintaining their historical margins of around 70%. And based on this and based on their forward stable rental income base, we are looking at a cap rate for fair value per share of at least 46, which signals a 19% upside, and also factoring in the strong dividend yield of 6.5%, which is potential upside for a 1 year holding period of 25+%. And also another factor to sort of factor in is that the properties under construction, which has broken ground in the south, has already sold about 100 units out of the 200 units, which would sort of add on to their revenue once they start handing over units, and their rental income would sort of be a base, whereas apartment sales or other projects that they undertake would be in addition to that, which would once again give them a good cushion to lean on in terms of a stable income. And next up, we'll be looking at the dividend counters. So these are sort of stocks that we pick in terms of a more stable approach. So number one, we've Chevron. So historically, looking back at periods of flooding and periods of turmoil where people had to sort of service their vehicles, especially during the 2016 2017 flooding, something that we saw was base oil imports volumes did really spike in terms of as people, had to use service their vehicles, change brake oils, change engine oil as well. And that was on the automotive front. And also looking at the industrial front, there also you had to, re-lubricant your, which also sort of spiked in both fronts. And also in terms of a margin pressure for this industry with the rupee stabilizing and also base oil prices being quite stable, Chevron have been able to make a comfortable margin of around 30 to 35%, which means which is quite low compared to their historics. But given that they maintain their prices or not reduce prices further, so historically what we saw, if you look at the past couple of months, they've been cutting prices consistently in order to capture volume. But now that consumption is turned to normalcy and people are servicing on time, and also the usage of vehicles is much higher. So as a result of that, the volumes have returned, so they don't have to cut prices further, which means they can maintain margins at the 30 to 37% mark, which has sort of given margin stability, which sort of improves earnings as well going forward. And also looking at it from as a quite attractive counter in a low rate environment, it offers a dividend yield probably north of 10%, around 9.8% for 2025 is what's expected. And compared to an AWFDR pre-tax of around 7%, so post-tax it might be much lower. It's quite an attractive counter for a quite stable business, but also it has that positive, also it has that potential uplift in terms of an earnings growth as well. Especially given the fact that the lubricant market was around 60 million kiloliters back in the pre-COVID run. However, it's currently hovering at around 50 to 52,000 kiloliters. So with the market going back to normalcy, we might see an earnings, both a top line and bottom line uplift, along with a strong dividend yield coupled with a 90% payout. So in terms of CTC, what we're seeing is quite a stable business. So they've been increased prices along with excise price hikes as well. However, last quarter, what we saw was a marginal volume decline, which we've seen historically as well for CTC, but that has not really scratched them in terms of their bottom line, neither their top line. They've seen growth. So they've been able to improve EBIT margins actually despite volume declines. They've been able to improve EBIT margins by about 5%, primarily driven by cost saving initiatives and timing variances for inventory purchases as well. However, going forward, what we're seeing consumption doing well, and as a result, we're expecting volumes as well to improve going forward, and also EBIT margins to sort of stabilize at the 80% level compared to the 75% it was in 2024. And also coupled with a 90% payout ratio, 90+% payout ratio, we're looking at a dividend payout of at least 10%, and it's a quite stock in terms of earnings. We're looking at stability going forward rather than massive growth potential, which makes it an ideal counter for a dividend yielding counters for a strong dividend payout.
With that, we come to the end of the slide deck. If you all have any questions, you could send it through on the Q&A box. So there's a question on what's your advice on investing voting shares versus non-voting shares? So firstly, the difference between a voting and a non-voting share is that with the voting share, you get the voting rights as well. Typically, what you'd see is your voting share would be trading at a higher price, and because of the fact that you get the right to vote as well, for the vote in when there's AGM or whenever there's a general meeting. So ideally, what I would say is that when you look at both of those, sometimes the voting share and the non-voting share would have different levels of liquidity. And also these would trade at different multiples as well. So for example, there are certain companies right now which have their non-voting share trading at a higher price than their voting share, which is an anomaly, I would say, in most occasions, because of the fact that liquidity is better in the non-voting share. And this, ideally, what I would say, when you look at whether are you going for a voting share or non-voting share, the first question is, I would ask myself is, are you buying this as a strategic stake for you to get control of the company? In that case, yes, the voting share is something that you should go for. But if you're looking for returns completely, if your non-voting share has a better price upside or better liquidity compared to your voting share, in a situation like that, a non-voting share might make more sense than the voting share. If you're looking at it completely from a financial return perspective. There is a question on PICME. Sajid, would you like to take that?
In terms of the outlook for PICME, so what we are seeing is a structural shift in terms of how Sri Lankans view transport from primarily what it used to be was to have your own vehicle or use public transport. But PICME sort of came into the market as a cheaper alternative, and it's currently the market leader in terms of the ride-hailing space on based on what the company sources do say. So in terms of the outlook for this year, what has sort of happened is we are seeing volume growth quarter on quarter, and also we are seeing, however, we've seen a couple of new entrants into the industry, which does not seem to have wavered pick me. So with obviously the economy turning to normalcy and also economy sort of being on that booming phase, we'd see more travel happening as well, and tourism also would be another key catalyst as well. So we are looking at a period of growth for Pygmy at this, and we're probably looking at in terms of the number of trips taken and in terms of the kilometers traveled, especially as they expand their coverage across the island. We are looking at probably a good year of growth as well going forward as well, in terms of both top line and bottom line.
There are two questions on what are the expectations for the market. So typically, yes, we've been in a bull run for quite a large period of time. And we've had certainly, I think earlier this year, there was a bit of a drawdown that happened on the market for the market to cool down. And a few weeks ago also, we've been seeing a few red days that came through as well. But today being one of those days. So overall, for the next 2 months until the end of January, typically, uh, December is a bit of a slow month as well, given the fact that it's the festive season. There has been, and it's more of a off-season off period as well. So what I would say is it might range over the next 2 weeks, and as you move on to January again, that's when the market might find momentum. Technically, these next few weeks might be a cool off period as well, because the market is basically an engine, and your engine, when it overheats, sometimes it needs to cool down as well. So this might be that cool down period as well. There is no major reason for the market to see a huge drawdown right now. So it's more of a cool off period, that you'd see until the end of the year. And once you hit January, with more positive news coming, particularly from the multilateral and bilateral funding perspective, there might be some positive sentiment that the market might have on those news as well. So yeah, over the next 2 weeks, it's likely to be a sort of a cool off period. When paid dividend, is it guaranteed that both voting and non-voting get the same payout? So if you look at it as a payout ratio perspective, it'll be different because they trade at two different prices. But typically, you'd find both of them having the same value. So the value per share you get a dividend is typically the same amount. So if you're looking at it from a return basis, because usually your non-voting share is the lower price, and because of that, your yield on a non-voting share might be higher. Because if the typical scenario of the same price for both the voting and the non-voting continues. I hope that answers your question. And with that, I think we can come to a close to our retail webinar. Thank you so much for joining in for today's event, and looking forward to see you all in our next retail webinar as well. Hope you'll have a lovely day.